On the podcast with us today is Larry Abramowitz. And Larry, welcome to the podcast.
Thank you. I'm glad to be here.
Well, Larry, I want you to get us started first because I know we're going to be diving into this one property that you closed on in 2018 called Osprey Landings, located in Daytona Beach, Florida. It's a Class B area and it's a Class B property in a Class B area, 108 unit property. But before we dive into that deal very specifically, why don't you give the listeners a little bit of a background about yourself and where your current focus in multifamily is right now?
Okay. Grew up in Costa Rica. Moved to the States in 1990 to go to school. I went undergrad to Boston University, manufacturing engineering, then went to work for General Electric, aircraft engines and appliances manufacturing. I went to get my MBA at Wharton at the University of Pennsylvania. And after that, moved to Colombia, was running a paper manufacturing company down in Colombia for about 3 years. And moved to Miami or back to the States in 2000. Started a flower importing and distributing business, which I still have. And around 2014, I decided to get into real estate, just to start getting additional income and planning on future, looking at setting up future rental income to have additional income and started buying foreclosures around my area, basically around my neighborhood in Miami. I live in Miami, Florida, and I started looking for foreclosed properties or bank-owned or foreclosed properties, and that's how I got into real estate. I started buying houses around my neighborhood, fixing, flipping. I kept a few. I flipped some of the others, and I just kept on doing that. And whatever I could find that made sense, I ended up buying also a warehouse in foreclosure that we had to clean up and do, fix all the violations and go through all that process. And I still have that rented, and also got into retail, which was a restaurant that also bought in foreclosure and leased it and sold it. And basically I started getting into commercial until I ended up with all these properties, and I really saw the commercial was the way to go. I didn't want to own any more single family homes, so I started selling all these houses and apartments that I had, and decided to go into multifamily last year.
And this was your very first large multifamily deal that you had closed on, correct?
First multifamily deal, yes.
Yeah, well, this is going to be exciting because I know there's a lot of people that are listening that they're on the fence and they haven't really closed on that first deal yet. And so hopefully this will be a motivation for them to be able to start to take some action, to be able to kind of see some of the things that you've done on this property. I know we didn't really talk a lot about it in the green room, but when I first met you, we had talked a little bit about this deal and some of the different challenges that you had with it and how you overcame them. So looking forward to diving into this one a little bit deeper. So this particular one is called Osprey Landings. Like we said earlier, it's located in Daytona Beach, Florida. It's 108 units, Class B property in a Class B area. What was the purchase price on this particular property?
$11.7 million.
$11.7 million. And how much did you put in for renovations?
Put in about we're going to put in for renovations. It's about $7,000 a unit total at the end. I mean, it was interior about $5,000 on the 1 bedrooms and $6,000 on the 2 bedrooms, and then we had some exterior work to do between the green loan for the bank program, for the green program, and also some things that came up in the inspection from the bank.
Okay, and how did you originally find this deal?
I was looking for deals basically in Florida to start, and I was underwriting a deal in Gainesville, and I was interviewing property managers, and I found this property manager that helped me underwrite the deal, and they said they usually get deals from owners because they have a lot of contacts in the industry. So they told me that when they were going to get a deal, they'll let me know. And couple of weeks later, he calls me. He says, I have 2 deals, but you got to make a decision quickly, because basically the way he works is he puts them under contract or under LOI, and then he'll basically assign the contract to whoever he partners with on the deal. So basically, he showed me two deals: one in Largo, Florida, which is north of St. Petersburg. It's near Tampa, like in that Tampa MSA market. And the other one was in Daytona. So I basically got in my car, drove to Largo, about, I think it was about 3 hours. I mean, I drove about 10 hours that day, or 12 hours, because I went to see that property, and then went across to the other side of the state to see the Daytona deal. And I mean, the numbers were very similar in price per unit. I mean, NOI, they all look basically the same. I just like the Daytona deal a lot better. I mean, it's a property that you walk in, it has a lake right in the entrance, in the middle of the property. A lot of acres, and it's just a nicer area, a nicer property. So even though it was pretty much the same numbers, market's pretty much the same as far as job growth, population, all that. So I really went for the Daytona deal. I mean, the Largo, I wasn't too crazy about the area where the property was located. It was a neighboring a gas station, so I didn't want to get into the environmental issues, or I decided to go for the Daytona deal. There really wasn't a lot of negotiation. I mean, it was more, this is the price I was already under contract at, and they sent me the underwriting. I analyzed it. It made sense, so I decided to move forward with the deal.
So basically, there's a property management company down there that has a lot of connections within within those markets, and they basically negotiate the price first with the seller, and then get an LOI under it, and then they basically assign the LOI to somebody else that might want to actually take the deal down, but the price has already been set.
Pretty much, yes. That's how they do it, and they partner with the buyers. So I mean, in this case, they wanted to partner, to co-GP the deal. Since I had just met him, we're just starting the relationship. I didn't want to partner with somebody we hadn't met each other yet. It was the first time we met, so I basically negotiated to just pay a fee for him bringing me the deal. I mean, they were already managing the deal, so they knew it very well, and they were going to continue managing the deal, so it just made sense.
Okay. So was that fee, was it like a based off the purchase price, or was it just like a flat 25 or 50,000, or how did you come up with that fee?
It was a flat fee that basically asked them what would they feel was reasonable, and I thought it was a reasonable amount, so we negotiated a fixed fee and just made it part of the deal at closing.
Sure. And so they basically assigned the deal to you, and then you took it over from there. Was there any other GPs in the deal, or is it just you?
Just me. They did invest in the deal.
Okay.
The property manager invested with me on the deal, so they're an LP. So
that's good.
Yeah.
So when did you actually so you got the phone call that these are under LOI a couple weeks after you met them. You immediately got in your car, drove both properties, the one in Largo, the one in Daytona. You decided, I want this one in Daytona, after you went back and kind of crunched some of the numbers. And from there, did you have to now move quickly, because you had to, between that LOI phase and the PSA, you had to get with the attorney, get the PSA in place and stuff like that, and all of that?
Right. I had already talked to the attorney a couple of weeks before, because I was already seriously looking at another deal. So I already had that part set up with the attorney. I mean, as far as who's going to be the attorney, and we had already did the first draft of the document, subscription document. So I pretty much had that part ready, and that helped, I guess, to move a little bit quicker on the deal. But then we were back and forth on the PSA, which that took, I think, longer than what I expected. I mean, usually they say it's 1 to 2 weeks. I think we were about the third week, and there was a lot of back and forth going on, and we got to a point where the seller said that we either signed this by today, or he's backing away from the deal. I mean, he wasn't going to sign it anymore. So, I mean, I guess the attorneys, they like to get picky about little things, and sometimes, you just gotta. I mean, there's only so much you can negotiate or go back and forth with. I guess you just have to move forward at some point, as long as the major things are taken care of.
So how long did it actually take you to get the PSA in place once you knew for sure you're going to be moving forward with it?
Well, we were under LOI, like, I think it was, if I remember, May 1st, and we ended up signing like May 24th or
Okay.
somewhere around there. It was toward the end. I mean, it was almost a 4-week process. I mean, so that was a little longer than I expected, which just helped me because it gave me time to prepare my presentation and talk to some investors and kind of start getting my things aligned to do the deal.
Did you have to put any earnest money up for this one?
Yes, it was. Well, let me think a second. I think it was 150 hard day one, if I remember correctly. No, it was 50,000 hard day one, and there was an option to extend another 30 days of closing for another 50. And basically, the hard day one, of course, you have in the PSA, things that you can get your money back is there's structural issues, environmental issues, zoning issues, which are, or things they're not disclosing on the numbers that you find out during due diligence. You can still get your earners back. So I mean, it's hard as long as everything they said checks. I mean, you're basically hard day one. So yeah, there was and sorry, I can't remember right now. I believe it was 50 or 100, and then I think it was 100,000 plus another 50 to extend for 30 days. That's
Okay.
how that was negotiated already.
Well, I think, one of the things that I'm hearing here as well is that, you didn't just all of a sudden decide once you got this deal, hey, let me go ahead and start building my team, meaning building the team with finding the attorney, right? You had already started building those relationships and had that in place so that the moment this deal came along, you could move quicker because you already had an established relationship. Even though you hadn't closed a deal yet, you've already had an established relationship with an attorney office.
Yes, that definitely, I think that's very important because that usually takes a while to interview and find the one that you want, negotiate the rates and all that. So that's important to have it at least that part ready.
Does your attorney also handle the SEC side of things as well?
Yes, he did everything.
Okay, and that's always nice to have an attorney's office that can kind of do both of those at the same time. It kind of streamlines things and reduces the back and forth with the outside attorney if you're using an outside SEC attorney.
Yes, it helps.
So what kind of issues, if any at all, came up during your due diligence process?
I mean, they basically, the property, there was really not a lot of negotiating that was going to happen. I mean, it was kind of a done deal. We did the engineering inspection, no major issues. There was the main thing there was the roof. There was no history in the city of any replacement. So I mean, amazingly, it's an original roof from 1985, and there's still no leaks. So that was one of the things that wasn't budgeted on was the roof, and they had some damage from last year hurricanes. So what we try to do is get the roof claim assigned to us because they still had time to put the claim in. So the seller offered to put the claim for the new roofs with his insurance company, and we decided to move forward because I was trying to get a discount for the roofs. And what happened is that, and we all missed that, my attorney, the property manager, and I missed it, is that on the insurance for that this prior owner had on his roofs, it was the actual cash value. And on insurance, they'll either give you actual cash value which is basically the value of the roofs after depreciation, which at this point they're worthless because they're 30 some years old, or you can get full replacement cost, which is really what you want on your insurance. I mean, if you get full replacement cost, whenever you have a claim, you're going to get the full value of your roofs back. In this case, we thought we had that, and we're processing the claim. We got a guy that was processing the claim. We got the claim assigned to us legally, and we started all this process. And towards a month later, we figure out that it was not that they were not going to give us much for the roof. So I mean, that was a item that was not budgeted, and That was really the major thing that came up was the roofs. That's about $250,000 to replace those roofs from 200 to 250. I got a few quotes. Try to negotiate with the seller. He did not want to negotiate. So that was really the major thing that came up during the due diligence.
So what did you end up doing?
Well, at that point, I mean, in the big picture, it didn't change the numbers that much. And at the same time that we were discussing the roofs, the owner asked for an extension on closing because we never heard the whole story, but it looks like they forgot to get the payoff letter from the bank, and they couldn't close on time when we're supposed to close. So I guess I got lucky, and I was able to negotiate at that moment for the extension. I asked for that discount. It was a daily discount that I was able to negotiate with them, and we ended up getting about $250,000 back at closing from the seller because he didn't only extend once, he extended twice. So we ended up making it at closing, and that worked out pretty well in our favor. I mean, so we got about $250,000 discount on the purchase price.
No, that's great. That's great that happened to you. Doesn't always happen that way, but that was nice to be able to get that extra, credit, if you will.
Yeah. And the roofs are fine. So, I mean, I guess the engineering report came out fine and everything. I mean, actually the engineer and the reason we thought they're newer and that nobody knows is, I don't know, they changed them after a hurricane or something without permits, because the roofs, when the engineer went up there were actually, he found in certain areas more layers. So they might be newer. They're just not permitted in the city. And that's why the engineering report came like they were 10-year-old roofs. And right now, again, there's no active leaks, so really they might not be original. I mean, we think they are because there was nothing in the city, but the inspector thinks they're not. So it's, it was one of these things that we couldn't really figure it out. But, we ended up doing okay with the closing after that.
So what did you guys end up doing as far as your projections? Like how I was like, is this a 5-year hold, 7-year?
It's a 5-year hold, the way on the road the deal. And it was, the nice thing about this deal is a big value add play. I mean, they had some minor upgraded units where they were already getting a premium, and they had done a couple of fully upgraded, and then those that were getting a much higher premium. And it was almost about a $200 premium on the 2-bedroom and about $100, $150 on the 1-bedrooms with a full remodel. So they had already modeled like 26 units or 27 units, and we had in the budget to remodel the other 81 units, remaining 81 units. And
go ahead.
And we're already done like 12 units since I had budgeted 2 units a month, but we've been doing about 3 to 4 a month since we purchased the property, because we closed towards the end of September, and we're getting what we budgeted on the increases, so that's working out very well.
And what's the projected I'd say IRR on this particular project, and then the cash on cash on the 5-year?
The cash on cash 8.5%, and the IRR about a 16.5%. Again, depends on your exit cap rate. That's exiting at the same cap rate. If I exit at 50 basis points higher, it's about a 14% IRR.
Okay. And what was the occupancy upon acquisition?
It was, when we were doing the due diligence, they were on 95. At closing, we were closer to 98%. It's been around there since we acquired. It's been around 95% average. I mean, right now we're at 99.
What did you project the vacancy rate during renovations?
I kept the vacancy at 5% throughout because we're going to do very few units as they turn. So we're not really pushing, people out. We're just doing as the people leave. There's usually a 40% turnover on this property, so that's enough to remodel and get through it at the same vacancy that we're already getting in historically. So we didn't really increase it.
And what was the projected time frame for completing all the additional renovations on the non-renovated units?
We estimated about 3 years.
3 years.
Yeah. I think we'll probably get them done in 2, but we estimated 3 years.
Yeah. But get it done in 2 years would just make it even better returns for the investors. That's great.
Yeah, we already have the money, so to remodel, so that we just got to get it done quicker. That's what I'm trying to do right now. Is any unit gets vacated, we push the remodels.
And are you having the third party property management company that's now on the LP side? Are they the ones managing all this process?
Yes, they are.
Okay.
They're basically the manager on site. We outsource a lot of the work, so it's mostly supervising. But yeah, it's coordinating, supervising that all the materials and everything are ready for the remodels.
So here's a question that I don't think I've ever asked anybody. So here we go. You ready for this one, Larry? So you have this deal. You've raised 5,000 to 7,000 a unit. So you have, lots of money. Let's just do a quick calculation here. Let's just say we did 6,000 per door. You got approximately 80 units. You got about $500,000 that you've raised for the renovations over the next 3 years, correct?
Well, we have a little bit more, but it's about right.
So let's just say we have a little bit more. We got 600,000 or 700,000, maybe 800,000. That's just sitting in the bank account, right? That's ready to be deployed, ready to be used to renovate. Where does that money sit? Does it just sit in a checking account until you draw off of it, or are you trying to do something to make that money work while you're not actually deploying it, or what do you do with that money?
I have it in a money market at 2.1% right now. And I really can't do anything else with it. I'm not going to reinvest it somewhere else. It's really, you can't. It's not something that I even consider, but we have it at 2.1%. And the idea is the reality is you got to spend it the sooner the better, because you're going to make better returns, when you remodel the unit that's sitting on the bank. So that's really the way to go. I thought about doing a capital call and not having all that money sit in the bank for so long, but we'll go through it in half of it in the first year. So it's better just to have it, because if you don't know what's going to happen, with the economy or the investors in the deal, and when you do a capital call, they might not be ready to deploy capital again. So I rather had all the money up front, and I have to ask for it after the deal's been closed.
So when you were doing your underwriting and your modeling, did you put in there the returns that you would make off the money market, or is that just kind of cherry on top?
No, it's cherry on top. Yeah.
Obviously, it's a small amount, but 2.2% over a 1 to 2 year period of time, or even 3 years, isn't significant. But again, it still increases the returns for investors. And if you didn't project that, that's still great.
Yeah. It's not in the big picture. It's not a lot of money, but everything adds up.
Yeah.
Right now we're getting about $1,700 a month, I believe, on that. So it's not bad. It's an additional income.
Yeah. So where were the rents on the non-renovated units?
On the 1-bedrooms, we've been anywhere from $750 on the low end to $900 on the higher end, and we're raising them to $1,069 is the projected. The 1-bedrooms always seem to be harder to raise, because usually people don't have a roommate to share with the cost. So it's we're probably getting $1,050 through $1,069. Also depends on the time of the year. But when we started renovating, it was a slow time for 1-bedroom, so it was a little harder to get people in. I guess there's some students because of some schools in the area. So I think when we get those in towards the summer, you can get a little more aggressive with the 1-bedrooms. On the 2-bedrooms, same. There's rent from $900 to $1,000, and we're up to $1,200 on the remodeled units.
And the ones that you've renovated so far, and the ones that have been renovated before, they were already achieving that?
The ones that we're renovating, we're getting $1,200 on the 2-bedrooms.
No, that's great. That's great. So that's one of those things that it's great to have the proven business model in place, and then being able to turn those units and renovate them and get those is also a great idea. But one of the things I also look at this is I go, one of the best things about this deal is that you have a lot of extra cash, so that if for some reason there is a downturn in the economy or a correction coming up or whatever, you could hold through one of those types of corrections. If you had to like stop renovations, let's just ride through this thing, you could still maintain and still ride through it. So I think even though you raised all this money up front, you're holding on to it for 2 to 3 years. It also makes it a more conservative deal, because you're hedging this based on possible corrections in the market too, and having that extra capital.
Right. And we also have a DSCR on the loan of 1.25, so that also you have some coverage there. But yeah, we already increased. Actually, we calculated yesterday in a weekly meeting that our NOI at the T12 was 665,000. I'm reading here the numbers, and we just did like a T3 projection, of income with T12 expenses, and it's we're probably up almost $100,000 on the NOI already.
Congratulations, man. That's awesome.
Yeah.
That's awesome.
Thank you.
Yeah. And so are you still having, or not still, but is your plan to continue to do weekly calls with your property management company during this process?
Yeah, I always do the weekly call. I mean, you got to stay on top of what's going on, especially when you're doing a lot of remodeling. We did the clubhouse, the gym. We're redoing the pool pavers. The tennis court has been abandoned for I don't know how many years. It's just a really bad, ugly thing right in the entrance of the property, and we're gonna paint it, do a half basketball court with nice colors, and the other half we're gonna do a barbecue area with a fire pit. The barbecue fire pit was not planned, but the bank required us to resurface the tennis courts, so we have to do it anyways. We're just gonna do half tennis and half like a entertainment area, and just use some of the cash that we have to do the pool, which wasn't planned either, like the pavers. I mean, these are all some extras that I decided to do because we were able. I mean, we had already raised the cash, and then we got the discount at closing, so and the bank required some reserves, and basically they gave us more money at closing and kept some in reserve. So they gave us another $125,000 at closing. So that just gave us some extra cushion and cash that now we're doing some additional things to the property that were not planned. I mean, some better landscaping. So slowly we're going to start fixing a lot of the outdoors that they still look very nice, but we're just going to make it a little bit nicer.
Why do you think that, because I've seen this a lot, why do you think a lot of these tennis courts are not being utilized on these properties where they back probably 15, 20 years ago, they were putting these in probably thinking they're going to be the best thing. And now a lot of properties I'm seeing are doing just what you're saying. They're repurposing them into, some sort of a sport court or something like that, or a grilling area on one side and stuff like that.
I don't know, tennis, I don't know if it's not popular anymore or people just don't, they don't play as much. I mean, it's not I don't know, in Miami, maybe in the higher end properties, you see a lot of people playing tennis. I think in this type of workforce housing, you don't get a lot of tennis players. I don't know, it's just not a popular sport. I mean, I guess in I'm talking about my property in particular. I don't know of other areas, but I just don't, it's underutilized. I mean, I saw guys, I was there on Monday at the property, and people play basketball. It's an easy thing to, grab a ball and play with anybody or by yourself. I mean, tennis, I don't know. It's just not.
Yeah. Well, maybe that's what it is. Because what's the vintage of this property?
1985.
So I bet back in 1985, this was the Class A property in the area. And so there was Class A, residents there, and they were one of the ones playing, tennis. And then as the property aged, you got a lower class tenant in there. And like you said, that class of tenant is not going to really play tennis. And so that's where you make that decision to transition it into something different.
Yeah, and we thought about what to do with it for a long time. I mean, then, we're going to do some games also, maybe some shuffleboard or, cornhole or just different activities that people can play while they're barbecuing and, just figure out how to repurpose it. But it will look a lot better. I mean, it will really change the property. So I'm excited to see what it's going to look like.
So let's talk about the financing on this deal. How did you end up doing the financing on this? What kind of debt did you put on it?
Fannie Mae loan. It's a 15-year fixed 30-year amortization, and we got a 4.88 interest rate, and 8 years interest only.
8 years?
8 years IO.
Wow.
But because we went with 15-year fixed, so I mean, here really, I mean, with this property, you either exit in 4 to 5 years, and you give the buyer the. My thought about this was, first of all, lock the rates, because we were in in the middle of last year, rates were starting to increase. So, that was a big concern for everyone, was the rate increase. And I said, well, if I can lock in my rate now for 15 years, and I can give a buyer in 4 or 5 years, still give them 3, 4 years IO, I mean, it's an incentive for them to assume the loan, because they can get a supplemental on this loan. And that was my thinking. And if rates go up and we have this fix, I mean, also for another buyer, I mean, it will still be good to have a lower rate. Now, rates went down. I don't know if they're going to stay down, but they did go down in the last month. I don't know if that's going to be sustainable, but at least for now, they went down on the very short term. But they were up 50 basis points. I mean, from where I closed. So.
So you did the Fannie Mae. Did you have any issues or problems during that process?
Yeah, I mean, everything was new to me, a lot of that process. So just getting the personal financial statements ready, making sure I had which I had looked at that prior to while we were doing the PSA. I had talked already to the bank, but also the property manager brought Berkadia, which they do most of the deals with. They already had quoted the loan. So basically I had to get qualified, and I did that during that period, and that worked well. What was a surprise and thing that I always recommend people to be very conservative is, and happened to me, is that before we were ready to close, they lowered my proceeds because the rates went up. So the deal was DSCR constrained, so they couldn't give me the proceeds that they estimated at the beginning in May, and we closed all the way in September. So that was a big deal. I mean, and I had already raised the funds, and just raising more money would have changed all the numbers. So, I mean, at that point, you either leave it the same and you just don't remodel all your units, or you have to change all the numbers and raise more money. But you don't want to do that with your investors. So we were able to work it out with a bank where they were able to give me all the proceeds, and also because the property, the rent roll improved in the last month. I mean, that also helped to offset some of that. But that's always a challenging thing, because you're working on a quote from the bank 2 months before closing, and things change. So what I always suggest people is use a higher interest rate, get more money than what you need, and it's never bad to have a little more money. Now, that's going to lower your returns, but it's better to show a little less returns and be conservative than to, be aggressive and then you get hit. I mean, you get hit with a 50 basis points increase, and you might not be able to close the deal, and you can have hard money on that deal and not be able to close, because now you have to raise $200,000-$300,000 more to close. I mean, and that's a game changer.
Mm-hmm. No, it definitely can be. Now, as far as loan guarantor, balance sheet, or anything like that, did you bring that yourself, or did you have to find an outside person to be able to help you with that piece?
No, I did it myself.
And so what about the experience piece of it? Because, obviously this is your first multifamily deal of this size. Was that a factor at all when you were working with Fannie Mae on it?
Yeah, it was, but I had prior real estate experience. I mean, I have been doing deals for 4 years, so that I showed all the deals that I had done, and just partnering or using my property manager, as he was going to keep on managing the deal. That was it was pretty much a requirement to have a third party manager, but also because they have a very good relationship with him, that also helped a lot.
Yeah.
I mean, he was a big part of making this work because of the relationship that they have with Berkadia.
Mm-hmm. And how much was the overall raise from investors on this particular deal?
$4.5 million.
So $4.5 million. And how many investors do you have in this deal?
22.
That's pretty low for that amount. That's great. You had a lot of pretty heavy hitters on there, at least, one or two or something, right?
I had about 3, 4 heavy hitters. I also put 100,000 minimum. I mean, there's a couple of things that I've asked friends that raise money or do deals, and not only real estate, but another, venture capital and all that. And they always say, start with a high minimum, because people will always ask to put in less than the minimum. So if you put 100, they're going to ask for 50. If you put 200, they'll ask for 100. So it's always easier to have a few people that are going to be under. But if you do 25, you're going to have a lot of people of 25, and that makes it a lot more difficult to raise. You might have a lot more people putting 25, but that means you have to have a lot more investors to deal with. I mean, so I started with 100, and it worked.
What was your biggest hesitation with starting at 100? Because, I mean, our group has always been at 50, and, every once in a while we'll let somebody come in at 25, like you said, because they might want to come in at a little bit lower. But, I think the biggest issue that it's a headspace thing, is a mindset issue, is, you put it at 100, you're not going to be able to raise as much because some of your investors only want to commit at a lower amount.
Well, it was the first deal where I was raising other people's money. I mean, I've never done it before, and I just follow what a lot of these guys that have been doing it for a while said. I mean, and even though I didn't have a lot of experience raising money, I mean, I get your point, but at the same time, you're going to work maybe with higher net worth individuals that, maybe are not going to be calling as much, or, as long as you're communicating well with them, they're not, calling you every day about their investment. It's part of how they work and how they invest in different deals. So I guess you get a different type of investor when you raise your limits. But again, like you said, they're always going to ask you for a discount, right? So if you said you're at 50 and they're asking you for 25, maybe you do 75 on your next one and they might ask you for 50, but then you might get less people or less investors. I mean, I don't know. How many of your investors are usually 50?
Most of them are. I mean, if we do, like we just did a deal recently, 130 units, we raised 2.5, and we have about 35 investors in that one. So most of them came in right about 50 to 75, somewhere around in there. We maybe had 3 or 4 that were below that. But I like the idea of the higher amount, and I think it does attract, a different level of an investor. And a lot of the investors that do invest 50 could invest 100, and I think that's where the balance is are you going to get some of those investors that are investing 50 that could go to 100, and that would balance out the people who can only come in at 50 that don't want to go in any higher. And that way it kind of balances it out, or even, makes it even more of a higher raise, because you have more investors bringing in at 100.
Yeah, I think that a lot of your 50 will probably can do 100, and the ones that can't probably will ask you to do 50, and you'll still probably get them if they're happy with what you've done for them. So I mean, I don't know, maybe you try it.
Yeah. You could always change it, I guess, right? I mean, now you did a 506B on this one, which is, family, friends, acquaintances, that kind of thing. Did you have any challenges trying to raise the money?
Yes, it was the most challenging part of the deal, was raising the money. Different than every podcast that I've listened to where everybody talks to the investors and has them aligned. I basically didn't have anybody aligned. I mean, I was maybe a few people that I've talked to that were interested because they knew I was doing real estate, and I've been talking to them about what I was going to do. But maybe I had 5 or 6 guys that were interested, and there were some of the bigger hitters, so that helped me. But at the end, I was concerned. I mean, it was a couple of weeks prior to closing, and I was still about $500,000 short, and I started getting very concerned. And, at the end, I was able to get it. I mean, it's just, I had to hustle a lot. I mean, I basically went through all my LinkedIn, Facebook contacts, friends from high school, friends from college, everybody. I mean, even clients in my other business. I mean, I called everybody that I knew about the deal and made it happen. I mean, but it was a very challenging process.
And how many phone calls did you actually make to be able to get that last $500,000?
I don't know. I didn't count them, but it was a lot of emails and phone calls, and I can't. I mean, I don't know how many there were, but there were just a lot of. I mean, it was a, and not only it's not only raising the money, but it was also the due diligence, the bank documents, the getting everybody's subscription documents. Being the first deal, I did everything manually. I mean, just email or printing the documents, and I mean, I even had people to come into my office to sign the papers and give me the money. I mean, so it was a little bit of everything, and I even had to go to one guy and get the money and have him sign the papers. So I ended up having scanned papers. I mean, the last time I ever do a deal like that, I mean, now I already set everything up with like DocuSign, and actually today I came from a meeting with a CRM company just to get all that organized, because I want to be ready for my next deal, because that was really a nightmare getting everybody to sign the papers. You always have a page they miss, or they didn't fill out part of the form, they didn't give you the address correctly. I mean, and also there was a lot of handwritten stuff. So I mean, we're sending out checks because this property manager is not set up for ACH, so we send the distribution checks, and there was a couple of addresses that they were wrong, or we couldn't read them correctly from the document, so checks came back. So I mean, I guess you learned that from your first deal. I mean, there's a lot of software out there you can use to automate this, but yeah, I want to try be ready for the next deal.
How did you structure the deal with investors?
7% pref, which was also challenging given that it was my first deal, and they were already investing with other bigger syndicators that were doing 8% pref, but they did admit that a lot of the newer stuff, they were lowering the pref because, as we know, multifamily has been getting the yields are tighter. So but I did 7% pref, and then all the capital back to the investors. And after I returned the 7 plus all the capital back, it's a 70-30 split. 70 to the investors, 30 to me.
Okay, so that's a little bit different of a deal. I don't think I've heard that structure before, where you basically are given a preferred return, and then they also get all of their capital returned back to them before there is a split.
Correct.
Right? Okay. So throughout the deal, you're not going to be bringing any of the cash flows home. It basically all goes back to the investors, whatever the cash flows are.
So yeah, the prep was a little lower, but it was a good. I think it's more of a win for the investors than for me, at least until I return all the capital, which really will only happen at a sale or at a refi.
Yeah.
I mean, so it's yeah. I mean, my incentive is, I mean, I invested on the deal $500,000, so I mean, I'm also getting the return as an LP, and I have my asset management fee, and I had an acquisition fee. So really, that's But other than that, I'm working for the return of my money that I invested. I mean, and until I don't give all the money back, I mean, I really don't get any promote.
Yeah. Yeah. And so you did a 7% pref, 70-30 split, but that's only after all of the initial capital has been returned back to investors, including yourself as an LP as well.
Correct.
And what was your acquisition fee?
On this deal, 1.5%.
And then the asset management?
I did it as a percent of the cost, which is I did 0.39 if I remember the number correctly. Sorry, but I did this presentation a while back, so I did. I'm checking here. Give me a second. I think it was 0.
I see it here, 0.35%.
0.35%, correct, of the total cost. And because there's a lot of remodeling being done, I mean, I get the asset management fee, and it's a little bit higher than the typical 2. But I'm involved in heavily in the remodel. I go to the property about every 2 weeks. I mean, so it kind of offsets a little bit not having a promote. But yeah, probably my next deal I'll structure it with the promote after the pref, because I think it's a lot of work that goes into the asset management. Even though you have a property manager, I mean, I'm very involved, and that helps increase the returns. And I think that, I mean, if you hit the prep, you should be able to get some of that promote back. I mean, so I think I'll restructure for the next deals a little bit different.
Mm-hmm. Okay. And so when you say the total project cost, as far as the asset management, that's the total purchase price plus the capex plus what you're collecting on, or where, how do you calculate the total project cost?
Everything, including closing costs and the remodels.
Okay, so whatever that number is upon closing, 0.35% of it, that's just paid to you every year throughout the life of the hold.
Correct. So it doesn't increase either. I mean, even if we increase the revenue, which is a typical asset management fee, as your income goes up, it goes up with here just a fixed fee.
Okay.
It's paid monthly.
Okay. Now that's something new, unique too, that I haven't actually seen before. So I ran the numbers real quick, and it's not really that far off of what you would see on a promote and an asset
No,
management. So it's pretty
but you know
comparable.
what was interesting? I had a lot of investor pushback the first meetings that I had, and it was, why are you making 1.5 acquisition, and then on top of that you make 2% every of the revenue, and they're not looking at the actual dollars, they were looking at the percent, which I mean, I guess it's a mental thing for an investor, but they're looking at now they're seeing 0.35, and for them it seems like it's a much lower number, and it was better accepted than the 2% asset management fee that's typical in the industry. So I mean, the negative, I guess, is as you increase your income, that's not going to change. So if, let's say, I hold this property long term, I mean, I'm basically making more at the beginning, but less towards the end. So it kind of averages out. I mean, I did the calculation before I send it out, and it was, if you hold it for 5 years, the first 2 years, I'm going to make more, but then the other years as the income goes up, I end up making less than what I could if I had maybe a variable one. So yeah, it's a different setup. I mean,
Yeah.
yeah.
So I have two final questions for you here, Larry, as we're wrapping this up. The first question I have for you is, what did you find that was a little bit easier during this entire process that you thought might be a little bit harder?
I don't think anything was easy.
That's a fair enough answer. That's a fair enough answer.
I
I
can't
can
think of
definitely
anything
relate.
that was easier than I mean, everything was the presentation was, I mean, everything was hard. I mean, it was just I mean, I guess the first one is the hardest deal. Oh, it's like everything is new.
Especially when you're doing it all yourself. I mean, I have to give you big kudos for that, because that's a big undertaking, especially as you're trying to run your shop as well.
Yes, it was a crazy 3 months. I didn't get a lot of sleep.
So the last question here is kind of the opposite of that one. What did you find that was harder than you had originally expected, that you thought might be a little bit easier during the entire process?
To me, the hardest was the legal. I mean, just it's a lot of paperwork, a lot of documents that I had to read, and just I spent a lot of time. I thought, like, just going through the legal. I guess it's also the part I like the least. So just dealing with all that legal and the legal fees, which are never what you planned. I mean, so that was another. I mean, this closing extended twice, so there was a lot of. I mean, it was just a very long process.
Well, as we're wrapping it up here, why don't you share with us a little bit about how somebody can reach out to you if they have further questions about the Osprey Landings deal that we talked about today, or maybe even jumping on a call with you about seeing what some of your goals are, and seeing if maybe you guys might be able to do some deals together yourself.
Sure. My email is Larry Larry at BroadviewCap. It's BroadviewCap.com. And my phone number, if anybody wants to call me or text me, 305-804-7399.
Well, again, Larry, thank you so much for taking some time out of your schedule to be with us here today and talking to us about this Osprey Landings in Daytona Beach. I wish you the very best on that one, and looking forward to having you on a future podcast episode as you close more deals here in 2019.
Oh, great. Thanks for having me.